Okay, I'm very happy to be here because as I look at the audience, I realize I have people here who taught me finance, and I have people here who I teach finance to. I graduated from METÜ, so my first finance instructor was Cengiz Hoca, Cengiz Erol. He's not here, but my second finance instructor is here, Nuray Hoca. And I look in the audience and I see my master's, PhD, and undergraduate students. So I feel extra special to be here and to be addressing this audience. So first of all, let me tell you, we have a slight change in plans. Our joint work with Asst has not progressed as fast as we would have liked. As a result, you shall be listening to still work in progress, but in a more refined stage right now. My work with my co-author, Mei Jun Chian, she's at National University of Singapore, and the topic is still financial institutions, just not banks. So this is about mutual funds. And this is also an interesting paper because this relates to the 2003 mutual fund scandals in US, where Spitzer went after, as the mutual fund industry tells it, went after them for stuff that everybody did and that the regulators knew and allowed until that point market timing and late trading. This was 2003. I was doing my PhD. I was in Boston. And I was talking with my friend Mei Jun, who was also doing her PhD. So the idea germinated at that time when we were reading about Spitzer and about his allegations into the mutual fund industry. By the time we started writing the paper, so this was 2009, as you can see again, this is a paper that took a long time from first idea to start writing it, doing the analysis. The allegations, the investigations had been concluded. For most of them, the funds settled, and they paid monetary fines. So the question we were interested in was, so these guys are going to be punished for the actions that they did. But this punishment, in what form will it take? So will it be only the monetary fees they pay as settlement, or will it come in terms of flows? And if it does come in terms of flows, when will this punishment take? As soon as the scandal erupts, so as soon as Spitzer announces so-and-so fund has engaged in market timing or late trading? Or is there some anticipation of these events or information leakage, if you like? So will some sophisticated investors anticipate these events and get out of the funds before everyone else does? So this idea of getting out before everyone else is a bank-related phenomena that we know from a bank run. So if you have a deposit in a bank, and if you know your bank is going to run into trouble, or if you anticipate that your bank is going to run into trouble, you have the incentive to go and redeem your deposit, because bank deposits have first come, first served mechanism, right? You may get your money if you're early enough. But such is not the case with mutual funds. So that was our motivation. So if we compare a bank and a mutual fund, in a bank, we'll have the depositor as the major investor who is financing the bank or lending to the bank. Whereas in the mutual fund, we'll have the shareholder. And if we look at the distribution of assets, if anything goes wrong in the bank or in the fund, in the bank, as I said, it's first come, first served. I go to İmar Bankası, I get my money if I go there early enough. And if I don't go there early enough, I will wait for my money. Whereas in a mutual fund, it doesn't matter, because the asset distribution is pro rata. I have 2% of the fund, I'll get 2% of the fund, whatever the underlying value of the portfolio is. And the third one relates to liquidity. If we think of the asset allocation of banks versus mutual funds, for most mutual funds, it's much more liquid than a bank. So at this point, what motivation is there for a mutual fund investor to go early, right? So we said, okay, are the funds going to be punished with flow? And if they are, is there an incentive for mutual fund investors to go early, as in banks? Because if there is, that means there is a potential for runs in mutual fund industry, just like banks. This question had not arisen in 2003, that there could be runs on mutual funds. But when we came to 2009 and the crisis, at which point the paper was still being written, we suddenly saw, hey, this thing that we were thinking about can actually happen, right? So a money market fund went bankrupt, and there was a huge run on the money market mutual funds. So there was a run on the most liquid of mutual funds, money market funds. So we were pretty excited. This paper is going to be good because we have additional motivation. That excitement has not paid off yet. Hopefully it will. So our questions still remain. Is there an incentive for investors to run a mutual fund? And we thought about this and we said it has to be about fire sale costs. There has to be some costs that you can avoid by leaving early. And if the asset distribution is pro rata, the only thing we could come up with, if an enough number of shareholders redeem their shares at the same time, right, they'll get the market value, but the fund the next day will be forced to liquidate some of its assets or change its asset allocation. And if enough of funds do this at the same time, so there are two conditions. If enough of your investors come to you, and if enough of the funds face the same kind of liquidity problem at the same time, then you could squeeze the market. This is what we saw in the money market mutual funds when they were holding commercial paper. And they had an outflow at the same time after, as I said, the reserve fund broke the buck, and they went to the market to sell their commercial paper, which is supposed to be very liquid, but everybody is trying to sell at the same time. Even liquid things can become illiquid. Hence, this was our motivation, and we went into the study. Okay. So I guess I went all over this. So I can also give you some preliminary results. The first thing was, is there punishment by the way of flow? So do investors who hear there's something wrong with my mutual fund, do they redeem shares? The answer is yes, both in the pre and post-event period. So there are some investors who anticipate such events and try to get out as early as possible, and after the event becomes public, this outflow is even more pronounced. The second question, what motivates mutual funds? We still think it's fire sale costs, but we are less able to find evidence precisely because of the reasons that Umut said. We don't have enough detailed information on the asset holdings of these guys. So what assets are they holding? What assets are they selling? That information, that's the information I need to be able to show that there is going to be an illiquidity in the underlying assets when these guys try to sell. So the first question, I have pretty much evidence. The second question, I have mixed evidence. So the literature on bank runs is huge, starting with Dybvig and going on. So we have Diamond and Dybvig, the sunspot that you can have a bank run with no rational underlying reason, just fear in the market. And we have the Chari Jagannathan paper showing, so an anticipation of an adverse event which applies to our case more, the anticipation of litigation can also trigger a bank run. So the fire sale costs in mutual funds, this has been shown in different studies that, for example, Kowal and Stafford show illiquid funds have underperformance, especially in times of economic downturn. So this kind of supports our idea is the reason these guys are trying to get early is because they fear these fire sale costs. And there is a Chen et al. 2010 JFE paper now published in JFE. They look at strategic complementarities, precisely what we are thinking is happening in this industry around the Spitzer investigation. They are comparing the performance of illiquid mutual funds versus liquid mutual funds across time. They have a time series cross-section panel data, and they compare the liquidity of funds and come to some conclusions about the fire sale costs. So let's talk about the allegations a little. When I give this talk, if there are any lawyers present, it becomes a little more complicated because they ask me technical questions which I'm not so proficient to provide. But late trading is trading after the official close. So this is strictly illegal. So this type of behavior is strictly illegal. If we read the definition, shares of open-end mutual funds are priced each day at 4 p.m. Okay? So if you want to buy or sell, you have to put your buying or selling order before 4 p.m. Otherwise, it will be settled the next day. So if the mutual fund allows you to trade, to buy or sell the fund after 4 p.m., it's giving you an information advantage because you know what's happened in the market, and the other investors don't have this advantage. The second one, market timing, is a little less clear. It's not illegal outright, but these guys in their prospectuses say, we are not going to allow it. So because they declared in their prospectuses, I'm not going to allow this type of behavior, it can also, they also get sued for it. So what is market timing? So you have an emerging market fund that invests in Turkey, right? The Turkish stock market closes at our time. So if the US investor can take advantage of the discrepancy between US closing time and the Turkish stock market closing time, this is called market timing. So the Spitzer allegations were related to these two practices. The Spitzer said that mutual fund managers were allowing some customers some trading practices that they were not allowing other customers. These preferential customers were hedge funds. And the other customers is everyone else. So you are everyone else, and you realize hedge fund customers are getting preferential treatment. That means you are paying for that preferential treatment. So our sampling frame is 1996 to 2005, and we get data from CRISP. And we also hand collect data. So flows and returns come from CRISP. Litigations, the timing of the litigations, we hand collect. Fund characteristics, some fund characteristics, we also hand collect. So if we look at the sample of our funds and the timing of these litigations, we see, first of all, that it started in the September of 2003 and came in waves, actually. So every couple of months, Spitzer said, I am going after blah and blah and blah. And if you look at the fund families, all of these guys, there is Bank of America, there is Fidelity, these are all the big guys. And you can see it ended at the end of 2004. So, some graphics first. So here we have flows, and we have categorized the fund industry into 3 implicated funds. So you have Fidelity. Fidelity has hundreds of funds. Not all of these funds are named in the investigation. So you have Fund A of Fidelity, which has been named in the investigation, Fund B of Fidelity, which has not been named in the investigation. So Fund A is implicated. It's in the implicated fund. But just by association, we suspect there might be some spillover effects because the reputation of Fidelity will be hurt. So hence we have funds in implicated families. So these funds are not named in the suite, but they are implicated by association. And then we have funds in families that are not investigated. So we have these 3 groups, and we looked at the flow. So the flow relative to size. So as a percentage of your size, what is your flow? And we plotted this through time. So we started in September 2001, and we ended in September 2005. So as I said, the first allegation was September 2003. So if you look at September 2003, you see a clear change in the trend. You see that the implicated funds flows suffered. And this suffering actually persisted for quite some time. And if you look before September 2003, these guys were the guys who were attracting more flows. So this goes back to, actually, this is not in the purview of our paper, but this goes back into why these guys engaged in these practices. So I, as a mutual fund, give you preferential treatment. What do I get back in turn? In turn, I get business, I get flow. And that might be one of the reasons why we see higher flow before the event. So I like this simple graph because we can see it visually. Once we have seen it visually, now I have to demonstrate statistically with the other controls that this change in flow is not caused by other factors. So we have flow regressions, cross-section panel data. We have a lot of controls in these cross-sections, as in size, lagged return, fees, style, fixed effects. So under these controls, we have a lot of dimensions. We also have dummies for the months of importance to us. So event month 0 is the month in which the fund started being investigated. And +1, +2, +3, this is like an event study, sort of, but this is like a monthly event study. Takes the event month and proceeds up or down. So in these regressions, we also have funds that are never investigated. So for these funds, these dummies will always take on a value of 0. So if we look at the flow regressions, what we see is significant outflows. And these significant outflows start even prior to the investigation month. So if you remember that first table, the first funds were investigated September 2003. But it came in waves and it continued until 2014. So it doesn't actually have to be information leakage, okay? You see Fidelity being investigated, and you're in the industry, and you expect, okay, they are going after this guy, so sooner or later, they're going to go after Janus. I should get out while I can. So I'm not here claiming this is information leakage or anticipation. It can be both. I don't know which. But as you can see, the outflow is significant, and it starts before. So our second question, why? So I said we think this is a illiquidity and fire sale cost associated story. As I said, I don't know the security holdings of these funds, so I don't know what they're holding, what they're selling. If I knew precisely what they were holding, I could look around the investigation and see what they are selling. And look at the price impact of those sales. Look at the bid-ask spreads, other liquidity measures for the underlying securities that they are selling, and see if they're suffering any costs. Since I can't do this, I'm going to look at returns. I'm going to look at fund returns. If these investigations hurt these funds, and as a result, they had to liquidate some of their holdings and suffered fire sale costs, it should show in returns. That's our reasoning, and we do these return cross-section panel time series regressions. So the same setup as the flow. Again, we have a lot of controls. I'm just showing the event months here, so if you read the paper, you'll see there are many controls in there. And what I observe is mixed, right? After, there seems to be some negative performance, but it doesn't look significant. Before, yes, there seem to be some, but what is confusing and what we find hard to explain with our story is the event month 0 positive returns, and it's significant. So my co-author, who works more in the mutual fund area, says this might be because they have switched to cash. I don't know. So this is where I tell you I have evidence on the flow story, but I don't have as much evidence on the underlying reason, the fire sale cost. The returns results is mixed. So then, okay, we said, all right, we have a flow story, we have a return story. In which funds do I expect to see this effect more pronounced? I would say in illiquid funds. So some of these investigated funds were more illiquid relative to others. So if it's a fire sale cost story, it would be precisely these funds that would suffer most from these litigations. So we did the cross-section for, we ran, remember in the other one we had panel. So we had time series cross-section. Here we ran individual fund regressions, and we separated the funds into liquid versus illiquid. And we tested whether the runs were different for these two guys. And what we found was, it was, for illiquid funds, the run is much more pronounced. Let's see. To conclude, I guess I'm on time, I must have sped up a little. Our question was, can a mutual fund suffer from runs? And we used the Spitzer investigation as a natural investigation for a trigger event. And we found in terms of flows that these guys are punished, not only by regulatory fines, but by losing business, both before and after the event. So if investors anticipate that you are going to be litigated and that you're doing something wrong, they are going to withdraw money from you, both in anticipation and after the fact. And we think this incentive to withdraw early is caused by fire sale costs, which we have some evidence for, but not conclusive. Thank you.